relax. Once the pandemic is over and people start going back to work to their normal or what used to be normal, I think things would change. But until such a time, like even people where you walk with your dog, you used to be the only person walk, and now how many people you run into when you walk? You know, like people are going out to walk.
Well, they have nothing else to do right now. I mean, there's really literally nothing else to do, right? So.
Okay, Janet or Eli, you can both come to Drummond Township and walk wherever you want.
There you go. Thank you. But believe me, don't post that on any social media because you might regret it after, because that's what happened.
Yeah, we'll let them go to Drummond North Emsley because we're on the same problem in Mississippi Mills. So
Yeah.
Anyway, so with that, I think I'm going to call the meeting to order. Are we expecting anyone else though, Sally, or is this?
No, this is it.
This is the group. Okay, perfect. So I'll call the meeting to order, and thank you all for joining us this morning. We have the, I guess, roll call first off. Sally?
I'm just going to say I see everybody here and I don't see anybody on the phone, so I'm good with how we are.
Perfect.
I've already noted it.
All right, perfect. So the first item is the adoption of the agenda. So be it resolved that the agenda for the February 8th, 2021 Finance and Administration Advisory Committee meeting be adopted as presented. Is there a mover and seconder for that? So Phil and Paul, thank you. And all in favor? Thank you. The agenda is adopted. We have approval of the minutes. Let me just get to my next motion here. So the minutes from our meeting of November 20th, 2020. So be it resolved that the minutes of the Finance and Administration Advisory Committee meeting held November 20th, 2020 be received and approved as printed. Is there a mover and seconder for the minutes? Eli?
So move.
Thank you, Eli. And Bill, is there any discussion from the minutes? Seeing not, all in favor? Thank you. That carries as well. And so that brings us to the draft financial statements, which I think everyone would have received over the weekend. And I'll welcome Mr. Glenn Street. Thank you for joining us in this way. And I'll pass it over to you to walk us through the financial statements.
Okay, thanks, Krista. It's my pleasure to join you this morning. Can everybody hear me okay? Okay, great. So I'll share my screen here. Hopefully that'll work. Are you able to see the financial statement, or do you see the audit findings letter?
I see you.
You still just see me?
Yeah.
Seen anything just yet?
Yeah, you need to share the screen, Glenn.
Yeah, that's what I thought I did.
No, it didn't catch.
Let's try it again.
You need to go in the bottom green where it says share the screen, and you click on that, and that should allow you.
Done. That's what I've done.
Is there a permission thing on our side, maybe, Sally?
Let me check that. No, I don't see anything on my end. What I'll do though very quickly is I'll find what you sent on Friday, and I can pull it up and you can just have me go through it.
Oh, there we go.
Oh, yay.
There it goes.
Okay.
Great. Slowly but surely.
Right.
Here we go.
So yeah, we'll just walk through the statements here, and certainly if anytime you have any questions, just let me know. I won't plan to go through it in a lot of detail. I typically like to start with the statement of operations, which is on our page 5. Is this, you're still able to see this on the screen? Is this large enough for you to see my copy?
Yes, we
Yeah,
can.
that's good.
Okay. So start with the statement of operations, and there are a few changes to the statements this year because of a change of accounting standards. So I'll try and highlight that as we go through here. The biggest change basically is is the deferred contributions, which is probably a good thing from the board's perspective, because that was always a bit of a discussion point in terms of trying to understand the deferred contributions and the amortization of same. So those are no longer part of the statement. So hopefully that'll maybe simplify things a bit. But in terms of the operations here, this shows the revenues and expenses for the authority over the course of the year and comparing that to the approved budget as well as the previous year. So the 2020 actuals are the middle column here. So the total revenue from the municipal levy was $3,168,000 versus the budget of $3,193,000 and previous year of $3,083,000. The difference being basically the special levy there as far as difference between budget and actual. In terms of other revenue sources, we do have a supporting Schedule 1 that gives further detail around the 664, which we can look at. And then the various other components of revenue here from the M&R grant, provincial grants, conservation area, donations, etc. So the total revenue for the year was $4,080,000. On the expenditure side, again, we have a schedule that provides further details around these various categories of corporate watershed, flood and erosion control, stewardship. And then in addition to what would be on your budget, we also have the interest on the long-term debt and the amortization of the capital assets. So we had total expenses of $3.7 million versus the revenue of $4,080,000, gave an excess of revenue over expenses of $365,000. And that's versus the budget of $843,000. And we have a note that reconciles this difference between the authority budget and the way it's presented here. Essentially, the authority budget is more or less on a cash basis and includes both operating capital and reserves from transfer, whereas this presentation here is primarily the operating side of the budget. So I will go to that note next to show this reconciliation between the budget as you approved it and what we're showing here. In terms of the accumulated surplus, and again, there'll be a schedule, we'll go through that. Began the year with 4.9. The surplus for the year 365 brings the accumulated surplus up to 5,288,000. I would just like to go to that note 10, which reconciles the budget, so you have a better, maybe a little clear understanding of reconciling this excess of revenue over expenses relative to the overall budget. So again, from a budget perspective, we're showing 843 here versus 365 actual. So I'm going to go to note number 10, which is on page
16.
Page 16, yeah. And note number 10 here for the budget. So it explains, explains here that the budget amounts were not prepared on a basis consistent with that to report the actual results. The actual results are under the new Canadian public sector accounting standards. So when you do the approved budget, authority budget also includes capital reserve transfer items. So again, if we look at where we left the statement of operations, we showed the budget surplus at 843 versus the actual of 365. So to get to the balanced budget as passed by the board, from that operating side, you had the acquisition of tangible capital assets of just over $1 million. You had the repayment of the debt, the Carleton Place loan of 277, and then you had some budgeted reserves transfers, 551 coming from reserves and 114 going into reserves. So that was the balanced cash budget that the authority passed. In terms of actual results, we were showing 365 as of the operating side. Acquisition of tangible capital assets was 117,000. We had the amortization of the capital assets, which is basically writing off the tangible capital assets over their estimated useful life. So that's 289,000. We had the principal portion of the debt repayment of 139. The interest portion was already included in this 365 number here. And then in terms of reserve transfers, we had 145 coming out of reserve and 117 going into reserve. So when you look at the results here, you can see that the actual surplus, 426,000 versus a balanced budget. The biggest reason for that primarily is in terms of less acquisition of tangible capital assets than was budgeted for, which I guess primarily was related to some of the work on the dams, and then less activity as far as transfers to and from reserves, which again, a big chunk of that was related to work required on the dams.
Glenn, I'm just gonna stop you for a moment. I thought I saw Eli's hand go up.
Okay.
Did you have a question just with the?
Well, I was going to ask you, Madam Chair, do you want us to wait to the end, or Glenn prefer the questions as they come along? I'm not sure which.
We can certainly deal with the questions as we go. Maybe that will be clear for everybody.
So Glenn, I'm not sure why I'm not transfer from reserve. So the actual is 145, but then we budget 551. Why is the number so different in this one here?
I think that's primarily related to the work that was originally budgeted for the dams. And so you can see there was a significant amount planned for tangible capital asset addition, which would have been repair or replacement, major repair or replacement of the dam, or one of the dams. And as part of that, some of that money was going to be coming from reserves. So because that project didn't happen in 2020, there wasn't the requirement to transfer money out of the reserves to offset spending on the capital.
Okay. Now I understand what you mean. Okay, and amortization of tangible capital was 0 in 2020. Is that what you had there as 0?
Well, on the budget side, it's a non-cash item, so it doesn't typically get included in the authority's approved budget. It's writing off capital assets that have been acquired in prior years. So from the statement of operations, if we're reporting under the new standard, it is required to have the amortization of tangible capital assets on the statements. But as I say, it's a non-cash item. So when the authority does their budget, they typically don't include a line item for that amortization.
Okay, thank you, Glenn. Thank you, Madam Chair.
I can't see everybody, so if you do have a question, please feel free to put your hand up. And Glenn, I hope you don't mind if I'll interrupt you as questions may come along.
No, that's great, because I'm looking at this on the statement on my screen, so I don't have the hand raising in front of me. So that's great if you stop me as we go.
Sure.
Okay, so that's again the reconciling the surplus as it shows on the statement of operations versus what was budgeted for. So from that point, I'd like to go to the statement of financial position, which is here on page 4. Little bit different presentation to this statement this year as well. And basically, not significantly different, but there's just sort of 3 main categories now in terms of this statement. There's the net financial assets, which is the financial assets less liabilities. There's the non-financial assets, which is the tangible plus prepaid expenses, and then there's accumulated surplus. So we'll just take a bit of time to go through this, and again, we'll see a bit more detail around these main categories. So in terms of the financial assets, you can see the authority in strong position here in terms of assets on the books, financial assets on the books. The cash balance as of December 31st, 2020 was $1,335,000. Short-term investments, which are GSCs, there's no disclosure around that, is just over 1.6 million. And receivables, again, there's a no disclosure around that of 520,000. So your total financial assets, basically cash, or those that could be converted to cash within a 1-year cycle, just under 3.5 million, 3,461,000. On the liability side, we have accounts payable and accrued liabilities of 285,000. So money's owing to vendors. Deferred revenue, and we'll have a bit of discuss that note in a bit as well, of 379,000. So this would be revenue that the authority has received but hasn't yet well, I shouldn't say revenue, it's cash that the authority has received, but hasn't yet recognized as revenue. We have the current portion of the long-term debt. So that's the principal portion due in the next year of 144. The long-term portion of the debt, 3,780,000. And then we have the retirement benefit liability of 152,000. There's no disclosure on that. So the total financial assets are 4,743,000, with obviously the largest chunk of that being the long-term debt on the Carleton Place loan for the construction of the authority headquarters there. So your net financial assets are 1,281,000, which is the financial assets less the liabilities. The next category within the statement of financial position is the non-financial assets. Which
Glenn, I have a question here from Phil, if you
Okay.
don't mind. Go ahead, Phil.
Just if you could reconcile for me, the big difference in the cash of, say, almost $400,000. Does that represent, come from the amount we've taken from reserve? How do we get that high difference in cash available?
It's just basically when we looked at that statement of operations and the reserve that was generated in that note number 10, where we're reconciling the budget versus the actual reserve, we had a reserve balance there, I think roughly $400,000, and that's where you're seeing the increase in cash is the result of the operations, the positive cash flow that operations generated over the course of the year.
So we've just brought reserve money into the sort of the financial, there's still money left in the reserve and it's reflected elsewhere?
No, I mean, in terms of monies, when we talk about the reserve, there's kind of two sides to the reserve. Any monies, cash that's going to be used to finance that reserve is here. Like it's either this cash balance or probably more directly the GICs. So there's no other pot of money hanging around that is the reserves. Like any money that would be used for reserves would be here. It would be this cash balance and the GIC balances.
Thank you.
Okay.
Did we have any other questions before we continue? Okay, back to you, Glenn.
So I think we just left off with the net financial assets here then. The non-financial assets, again, are primarily the tangible capital assets, and there's no disclosure around that, of 6.5 million. And prepaid expenses, which is basically just the portion of the insurance premium that goes beyond December 31st of 2020. So that's the total non-financial assets of just over 6.5 million. And then we have the accumulated surplus, which is the 5,288,000. And we'll look at that in a bit more detail in note number 9. And then on here, we also make reference to notes 14 and 15 that talk about contingent liabilities or subsequent events. At this point, I'll go to the statement of net financial assets. So this number here, the 1,281,825 is what we just looked at here. So again, the net financial assets are the financial less the liabilities. So this statement just shows that over the course of the year. So we had the annual surplus of 365,000. Then other adjustments to that, we had the amortization of tangible capital assets, which is a non-cash transaction. We had the acquisition of the capital assets, and we had the change in the prepaid expenses. So overall, we had $152,000 net change here. So that added to the surplus that we had increases the net financial assets by 518,000. Began the year with a $1.8 million deficit. So we're now down to a $1,281,000 net financial deficit. And again, that financial deficit is these assets here less the total liability. So we're saying you're in a financial deficit, if you like, of 1,281,000, but it needing to recognize that, you know, by far the biggest chunk of this is the long-term debt. So when you look at your sort of current financial assets and your current liabilities, you're certainly in a surplus position, but you also have the long-term debt that's on the books for the acquisition of the construction of the Carlton Place property.
So Glenn, I think Sally and Janet both have comments or questions.
Okay.
Did you want to go ahead, Sally?
Yeah, I was just, you changed pages and I just asked if you could, just every time you change a page, if you could tell us which page you're going to, because
Oh,
you
okay, sorry.
didn't tell us the page. So I was sort of just scrambling to make sure I followed with you. Because I'm
Okay.
writing notes as you're talking on the screen there, so I'm not always seeing where you scroll to.
Okay.
Yeah.
Will do.
Janet, did you have a question? Oh, you're just, you're muted, Janet.
Sorry, more of a clarification. From a macro view, Glenn, the reason that we're seeing this increase in cash is, from what I recall, the fact that we had a capital levy that we didn't spend in 2020 because we weren't unable to do the dam work that we had planned. So that the cash increase is due to that revenue that came in from the capital levy that will probably, will be spent in the future on dam work that needs to be done. So that's kind of a macro view, is that correct?
That would certainly be part of it. So I'm going to flip to page 5. Yeah, so that statement of operations, when you look at these various sources of revenue, yes, included in here would be revenue received relative to capital type expenditures. So you're right, part of this excess, you know, if there were monies received for capital purposes, that would be part of that for sure.
Thank you.
Any other questions? Okay, I'm not seeing anything else just right now, Glenn.
Okay. So I'm going to go to note number 9, which is on page 16 again. So this is going, this again, you recall when we were on the statement of financial position, we had a line item there for the accumulated surplus. And so this is showing the components of that accumulated surplus. So we've got the investment in the tangible capital assets. So again, that's, we'll see the note disclosure on what's included in your tangible capital assets at $6.5 million. That would be representing the capital assets that the authority has either built or purchased at its cost, not at market value or not at replacement value, but simply at the cost that's on the books, less what's been written off as amortization expense. So less what's been written off to try and represent its estimated useful life. Then we have the unrestricted deficit. And so here, essentially 2 components. We have the long-term debt, which was used to acquire these, you know, a significant portion of the tangible capital assets. And then we have the operating side. So this line item here is I guess the operating reserve that the board would have been sort of tracking before. Started the year at 918,000 and now it's up to 1,345,000, which would be that, you know, 400,000 increase that we see down here in terms of the sort of the net surplus. So that's showing the increase in the operating reserve. And then you have your other reserves, which total 1,320,000 versus 1,349,000 the previous year. So the changes there were an increase in the conservation area reserve, small increase in museum, small decrease in the vehicles, Looks like a 90,000 increase in the water control structure reserves and $140,000 decrease in the Glencairn reserve. So those elements together, the investment in tangible assets, the unrestricted deficit, which includes both an operating reserve and the long-term debt, and the monies that you've got in you've designated for reserve of $1,320,000 is your $5,288,000. And again, to Phil's question, earlier question, in terms of where the cash is to offset these reserves, that would be the bank balance and primarily the GICs that we saw on the statement of financial position. From there, where do I want to go next? I think I'll just go through the notes. I'm not going to go through them all. I'm going to start on page 10, which is the notes to the statements. Note number 2 is a summary of significant accounting policies. And that's where we identify that the statements have been prepared in accordance with Canadian public sector accounting standards. And previously, the authority had been using Canadian public sector accounting standards for not-for-profit organizations. So there's a bit of a difference between the two standards. It was the recommendation of my institute, CPA, that using the Canadian public sector accounting standards would be more suitable for the authority than using the Canadian public sector not-for-profit organization standards. So there was a little bit of change in terms of the format of the statements, and there is a restatement of the deferred contributions, and there's a note that looks at that, so I'll get to that here before too long. Moving forward to page 11, just again, more discussion around the accounting policies under the public sector accounting standards that are used in the preparation of the statement. So I'm not going to go through all of those in any detail unless you have questions.
Glenn, before you
Yep.
go ahead, I have a question from Phil.
Okay.
Yes, could you go over again, who makes the decision about changing these standards? Is this something that we as an authority ask for? Or is this what the accounting profession thinks is the right way to do it? And we sail along under that? We seem to do, I've done some significant changes in past years, and I'm never sure whether that's what we think is best or what the accounting profession thinks is best for us.
Yeah, it's kind of a mix. Like, and when you talk about the Canadian public sector accounting standards, that's kind of a joint control, I guess, if you like, under government authorities as well as the CPA. So the Canadian public sector accounting standards would be what's used by several different levels of government: federal, provincial, municipal, what have you. And so, yes, there's a overreaching board that sets direction there, and it's sort of joint between government representatives and CPA. So, yeah, it's a bit of a mix in terms of establishing changes to the standards and the various policies within those standards. So I don't think that the CPA can take all the credit or all the blame, but yeah, it's a joint initiative.
Is it more costly? Could I just ask a further question? Is it more costly to do it one way than the other? Or is it just a matter of trying to go with the flow of what the government and the accounting profession think is right?
Well, the authority is required to follow the standard that's prescribed for them. And so there was some question as to which of the two standards would be most appropriate for the authority, whether it was public sector accounting standards or the public sector accounting standards for not-for-profit organizations. And it's the direction now is that it is the Canadian public sector accounting standard that would be the most appropriate for the authority to follow. So they don't, from that perspective, I guess they don't have a choice. I think would be consistent with the standards that you would see for the municipal standards statements, sorry, that each of you are probably see in your the rest of your portfolio when you're, on city or municipal council. The statements there are probably prepared under the same set of accounting standards.
Yep. Thank you.
Okay. So I'm just going to carry on with these policies, which I'm on page 12. I'm just going to carry through that. And now I'm on to page 13, I think here. Yeah, 13. So note number 2, the top of page 13, does provide details under regards to the GICs. So you can see that they're all maturing. Some have already matured in 2021. So the total there is $1.6 million. There's nothing that goes beyond 2021. So there's no long-term portion. In terms of receivables, which was we saw on the statement of financial position, you have government and trade receivables of 209. We have the wage subsidy of 169, and we'll speak to that in a minute. Special levy, HST rebate of 87,000, and monies that have been pledged by the foundation of 17,000. So a total of 520. In terms of the emergency wage subsidy, had some late news on that, or at least Sally had some late news on that on Friday. So initially, the authority had applied for the wage subsidy and had received some of those monies already, and some of them were still pending. And I guess at least one authority, Sally can probably speak to it better than I, but at least one authority has received some indication from CRA that they are not going to be eligible for the wage subsidy as a result of them being considered a municipality. Municipalities are clearly not eligible, but there was, and still is, some question as to whether or not the authority is in fact a municipality for CRA purposes. So at this point, the wage subsidy that's still hasn't been received is 169,000. And because of the information that came to light on Friday from the other authority, we've put the amount of the monies received, or either already received or on the books as having still owed for the wage subsidy. We've also moved it into deferred revenue, recognizing that in fact the CRA may look to claw back or recover that wage subsidy that's been received or has been applied for. So the revenue from the wage subsidy is not currently in the revenue for the current year. It's all been set aside in deferred revenue pending further resolution, I guess, in terms of what might happen with that wage subsidy, which kind of leads us into the next note here, number 5, which is the deferred revenue. So in terms of deferred revenue, we're showing a year-end balance of 379,000. So again, this would be revenue that we haven't recognized in the statements of operations as revenue to this point. It's money that's been received or expected to be received, but not yet recognized as revenue. So there you can see the big chunk for the wage subsidy. There's 280,000 sitting there pending final.
I'm taking Daryl for a side appointment.
Sorry, was that a question or?
Oh, could I just ask, who is making the best representation? Is it Conservation Ontario to collectively say, no, we're not municipalities, we can't borrow money, lots of, we're quite different than a municipality? Or should that come from the accounting people? Who's making the best case? Perhaps this is not the right place to ask that question, but I hope it is underway.
Yeah, maybe Sally would want to respond to that.
Yeah, so when this grant first came on the scene, there was huge discussion and debate around this amongst all of the CAs, and there was quite a difference of opinion, quite frankly. And some CAs ended up applying, as we did, and others didn't because they felt fairly confident that we wouldn't qualify, and if that monies were received, that it would be clawed back. But because some of the biggies did apply, and the one that got notice on Friday afternoon and quickly circulated it out was Niagara. And the letter from CRA actually says all the other CAs who also applied for this grant and received it will be receiving similar notices shortly. So of course that went like lightning around the GMs on Friday afternoon, which is why you got this late in the day, because we had to go back and Glenn thankfully was able to redo our statements. So in answer to your question regarding the approach going forward, this literally was hot off the press on Friday afternoon. And so there is talk about the CAs that did apply and did receive money consolidating their efforts to appeal to CRA, but literally there's been nothing that's moved forward. I don't know whether CO will take this on because it's not as if all of the CAs, and I don't even know whether half of them applied, because to my recollection, I think there's maybe only 10 of us who applied and received funding.
Congratulations on taking the aggressive point and say, we believe we're eligible, and if we have to give the money back, we have to give the money back. Thank you.
Okay, so we were just at the point of the deferred revenue. So we talked about the wage subsidy portion, which is obviously the largest chunk of other monies that have been deferred here. So I don't know if there's any other significant amounts here. In terms of the long-term debt, that's obviously the loan with the town of Carleton Place, which runs through to 2040. So the total debt at this point is $3,925,000, of which 144 is the principal portion due in this coming year. And these are the principal payments over the next 5 years. The retirement benefit liability, I don't think I'll spend a lot of time on that. That's just that attempt to show the cost, or the potential cost of the retiree plan, and put that on the books. Rather than just expensing it as payments are made, it's an attempt to show potential liability associated with that retiree plan as employees are working. That's consistent with what we've had in prior years, and that is required note disclosure. So I don't think I'll go through that in detail. Note number 8 is the tangible capital assets. So there's the capital assets that are on the books at cost, $11,417,000. The buildings and water control structures being the largest chunk of that. The cumulative amortization, so the amount that's been written off to date, is $4,869,000. So the net book value, which is the cost less the amortization of $6.5 million, is what we showed on the statement of financial position as the carrying value of the tangible capital assets. Going forward to page 16, we've already reviewed note number 9 on the surplus. Okay.
I've got Sally who wanted to say something, and Phil who had a question. So Sally, you're muted.
So Glenn, further to our conversation on Friday, the original cost, like that $11.4 million, was based upon either actual or estimated original costs. So in some cases, we received assets for free. So would they have been valued at zero, do you know?
I have to go back to that original worksheet. They probably were. Like, I think it was only based on cost incurred. So if something was gifted, it was probably not included in the cost. We could go back to those original capital worksheets and see what was there in terms of the water control structures and the land and building to see if it's something different than that. But I would expect it was just any amount actually paid.
Okay, thanks.
And Phil, you have a question?
Yes, just a quick one on the employee retirement fund. Does this mean if interest rates are low and we don't get the returns that we expect, we may have to put more money into that fund to fairly treat our past employees who are not OMERS member?
Well, there's two different things. So there's the pension plan for retirees, which is another note, and there's an OMERS that is in existence for the employees hired since whatever that date was, it's in the note. And then before that is the group RRSP. So there's that pension plan in place for all employees that are retired. And then this retirement benefit liability is just for those employees that retired at age 60 or somewhere between 60 and 65 that have 25 years of service. They're eligible.
I'm familiar with those. What I'm concerned about is, or wanted to ask the question about, was the London Life Group RRSP. Have we, or do we have additional liability under that plan if the income generated isn't sufficient? In other words, do the employees guaranteed a certain amount, or does it just depend on how well we do in the market, I guess, for those past employees?
Yeah, that's down here on note 12. That's a defined benefit plan. So yes, that is dependent on the investment performance of that plan. So potentially any of the contributing members, if the investment return is not what is expected, could have additional contributions to make there. Yes,
There would be additional obligations from both the authority and the participants, or
yeah,
just the authority?
There could be for both. Yeah.
Okay. And the other question I wanted to ask, I'm just not sure how I get, you have the book value of something and you add the amortization to it to get the actual value. Does that mean the cost of borrowing the money? I don't quite understand how we do that. You talk about
We're back at this
at the
number
bottom
8 here.
page, under number 8,
Yeah.
tangible capital assets. So to get the costs, you're adding the amortization to the net book value. And I'm not, could you help me understand that one a little bit? Like, does that mean we've borrowed money to get those assets, or why is there an amortization amount added to get the cost of the asset?
Well, it kind of goes in the opposite direction. So you start with the cost. So the cost is what, whatever the authority actually paid to either purchase an asset or construct it. So that's what you start with, is the cost. And then over time, what you're doing is you're writing off the cost of that asset to try and show the estimated useful life of the various assets. And so that's what the accumulated amortization is. So each year you write off an amount of the original cost and book that as amortization. And so that accumulated amortization builds up over time to reduce the cost, the original cost, to come up with the net book value. So if you take the example of, the vehicles here as an example, you might have bought a truck for $30,000 and you write that off at 30% a year. Or well, I guess a straight line. So it's probably written off over 5 years. So you write off a portion of that each year. So by the time, 5 years are up, or, when you're typically.
Okay, I got it now.
Okay.
Thanks.
You're welcome.
Any other questions just while we're paused? Okay, I'm not seeing anything else, Glenn. Thanks.
Okay. Just trying to remember where we left off here. I guess we left off there. Yeah, we left off with the retirement benefit plan, then we went on to tangible capital assets. So now I'm on page 16. So we've already talked about the accumulated surplus. We already talked about the reconciliation of the budget to actual. Related parties, just a note here around the relationship with the foundation. And the Mackenzie Trust. Note 12, we just started talking about that, was the pension plan. So there's the group RRSP, and then the OMERS plan for those employees hired after March 2012. And so we identified the contributions that the authority makes to the plan on an annual basis for each of those. Their contributions to OMERS are going up, and to the group pension plan are going down, as some of the group pension plan employees have retired and new employees coming on that are with OMERS. Financial instruments, I won't go into that. Contingent liabilities commitments just talks about the potential for costs related to litigation, but there's nothing of concern on the books right now. Subsequent events, we have a standard note disclosure here around just the uncertainty about the pandemic, but we've also added one in here about the wage subsidy that we talked about. The fact that CRA has notified some of conservation authorities of a pending protraction, withdrawal of that subsidy. So we've got a note disclosure saying that that's under review. Note number 16 is the change in accounting standards that I talked about earlier in terms of adopting Canadian public sector accounting standards, and previously it was the not-for-profit. And the significant change there, as I mentioned, was the deferred contributions and the amortization of same. So last year, this is what we would have showed as efficiency of revenue, 100,000. But if we convert it to the same basis as the reporting this year, we basically add back the municipal levy that was deferred for capital and take out the amortization of deferred contributions. So if we present the surplus this year, if we present last year's surplus in the same way it was this year, rather than being $100,000 deficit, it's a $210,000 surplus, because we take out those amortization transactions and deferral transactions around the contributions for capital. And then similarly, we used to have a line item on the statement of financial position for those deferred contributions. It's all been pushed back through the unrestricted deficit, so that line item is no longer there. And as I mentioned, I think that might be less confusing going forward to have the deferred contributions out of the statements. Economic dependence, we just talked about obviously the funding coming from the various municipalities. And then there's a discussion here on risk management. So yeah, I think that pretty much, I guess the ones we did skip over, I don't know that I have any comments, but maybe Sally or Angela might have some comments. It was the schedules here related to other revenue, which provides further details by program area of the various revenue. This is on page 8. And I guess back to one of the questions that was raised earlier about part of the surplus that shows, is monies received for capital that wasn't utilized. So as an example, in the budget, there's some money that was identified for capital purposes, revenue coming into for capital purposes, which wasn't utilized. And then the following page 9, is the further breakdown of those various departmental areas for the expenditures. But unless Sally or Angela has any comments on those two schedules, I don't think I had any, unless there were any questions.
So I see Sally does have a comment, and Eli as well.
Okay.
So you're muted, Sally.
Thank you. So on page 17, Glenn, where you're talking about the R. Tate McKenzie Trust. And during the year, the trust dispersed $0.7 thousand. I guess my question is that functionally, there is no board for that trust, and I guess I'm just a bit confused where this money is coming from and how it's being administered. And I know that's kind of a crazy thing for me to say, but maybe it's behind the scenes. It came through the foundation, but I was just a bit surprised when I saw this here on the weekend.
There's a direct line item in the Conservation Authority statements for revenue from the Mackenzie Trust. I don't have the detail of that right in front of me. I don't know if Angela off the top of her head,
Angela, do you
know what's.
Jump in.
Yeah, so those are actual donations that are received during the year to the authority that are specifically detailed on the donation that they're to be assigned to the R. Tate McKenzie Trust.
Okay,
as well as our parking revenue. Oh, no, sorry, that's museum reserve, sorry. Yeah, those are just pure donations that are received.
so if I can clarify then, just to make sure I understand, the donations actually were made out to MVCA, to our nonprofit arm. Is that correct, Ange?
They're made out to our Tate. They're made out to, sorry, MBC with the notation that they're to go. Yes, they are made out to MBC.
Okay, so we are the administrators of that money because it is coming to the nonprofit arm of the authority with a specification that it be going towards that trust. Okay,
That's my understanding.
great.
And there is in fact a charitable foundation for our Tate McKenzie Trust that is reported on every year.
Yeah. So just so you know, Glenn,
Separate from the authority.
so I think that's something we're going to have to address because given the court decision that we received just late last year regarding, you know, ownership and administration of the exhibits, the collection, et cetera, and where we're going as an organization, I can see where we're going to have to collapse this trust at a certain point because administratively it's unlikely to be administered through MVCA going forward, but we can deal with that as we go forward. I just want to flag this as something that's probably going to change between 2020 and 2021 or 2021 and 2022, but we have to do something about that trust on a go forward basis. So it's an action.
And I know Eli had a comment too, but he's, oh, there, maybe he's still there. Maybe he's not. We'll come back to Eli. Was there anyone else? Oh, there he is back. Eli, did you have a question as well?
Yeah, sorry about that. It just,
that's okay.
anyway, I had another question, but follow Sally's question, and I'm not sure. Unfortunately, I had to take the phone. Do we charge, or are we allowed to charge administrative fee for those donations? Because it's great they come to the MVCA and you know, and we issue the receipt and we do that. But is there's any cost recovery, staff time? Maybe that's for Sally more than it's for Glenn.
Yeah, I see Sally waving here. If we could go
Okay.
to Sally for an answer there.
Yeah, actually at our last meeting, which was just a couple of weeks ago, Paul raised the fact that there was a motion on record, and I have to find it, that provided for the MVCA to, oh, wait a minute, no, it's different. So what the motion spoke to was the ability for the foundation to take 10%, I think it was, of any donation and use it for administration of the foundation. But what your question is, I think, Eli, is for our staff time to administer. And I think, you know, it's 6 of one, half dozen the other, because we do charge back to the foundation for cost recovery, but mainly on expenses, not on people's time. So there is an opportunity there going forward to potentially have chargebacks between the authority and the foundation to allow for payment for staff time.
Well, I would like you, anyway, it's a policy issue. I would like to, you know, come back in the future with something of this nature. As you know, I'm in charge of the BIAs with the city. We, you know, we collect the money for them and we charge them percentage of managing the fund for them. So anyway, I'll leave it that for now. My question, I'm not sure, Madam Chair, if Sally or Glenn can answer this. So some of the work was scheduled to be done in 2020, did not get done. Now we're hearing the province and maybe the Fed to some degree, they might have a stimulus shovel-ready program. And I know those are shovel-ready for us. Some of we didn't do in 2020, obviously, for many reasons. Would we, and the question maybe Glenn can jump in, would we be allowed to leverage that amount allocated for 2020 and was not spent if a stimulus, you know, become available for us? Because some of the stimulus is coming to a lot of organizations, not necessarily just municipalities. So I'm wondering if we have any update on that.
I think that's maybe to Sally as well.
Yeah.
You can jump on.
Okay, so Eli, we have been having meetings with the city on this, and in fact, we met with Steve Willis last week, the 3 CAs. So I think as you're likely aware, the city had its long list, then its short list, and then a much more defined list of how you're going to spend your allocation. And the discussions that we've had with the city, we did amongst us put in some projects that were shovel ready, but our Shabamika project is not in the city of Ottawa, and that was going to be a hard sell. If we needed to do and had planned shovel ready work at Milliken-Tail, not Milliken-Tail, Morris Island, something like that, that was within city limits, we could have justified that, but not the Shabamika Dam. That would have been a bridge too far, as they say. And we did have those same sort of conversations with the other municipalities in the watershed, but the monies available was much, much less. And understandably, neither the counties nor the municipalities by and large were able to have the monies available to support that kind of size of project.
Well, I really appreciate that because, you know, I have two hats. When I'm with you, I'm here. When I'm in the city, I want to make sure you don't miss any opportunity. But I'm glad you clarified this because I just don't want to make sure you didn't miss anything. But it seems like you're on the top of all that. Thank you so much. And I just hope if we see something, maybe we can work with you and make sure it'll catch some of those projects because the city is preparing quite a bit of lists. So I hope something the Conservation Authority can benefit from. Anyway, thank you, Madam Chair, and thank you, Glenda. That was a great work today explaining all this. Thank you.
Maybe more Carp River restoration.
Here you go. See, ja. No shortage of idea from the chair of the board.
Phil, did you have a final question?
Yes, yeah, in number 11, we're saying that the foundation has pledged $10,186. Is that funds that they've actually raised, or was this the one that was if there was a fine involved, they were going to send some money? Can somebody clarify that for me? This is under note 11 about the foundation. It's on page 16.
I think, and Angela can correct me here, but I think in terms of this money, we're talking about pre-fine monies. I think that was going to be the 2021 transfer. This was 19.
There is in 2020, there was 10,000 coming from the foundation, and it's from the proceeds of the court order. So it is from that for 10,000 and 168. I think off the top of my head, was it postage reimbursement? So.
Okay, thank you on that one. Just, I note that you say in your notes that it isn't worth keeping track of the volunteer time. If staff in some organizations that I'm with, they do keep track of the volunteer time just to give some idea of the public commitment to that organization. And I think the MBCA has a much better public commitment in the Lakes representatives and stuff like that. And even if you just make a quick guess at it and say, well, their time is worth $15 or $20 an hour, how much work is involved? Like you would, as an auditor, Glenn, would you have to say, well, I got to go and look at and see whether get signed statements from all these people that they actually gave that much time? Tell me how would that be an insurmountable thing to keep track of?
Normally, if an organization wants to report sort of in-kind volunteer hours, it's just, you know, the organization provides a number for note disclosure. That would not be part of the audit. Because, you know, really no effective way to audit that.
Yeah. And the other question I had just on the foundation, somehow I feel I have the information that somebody told me it was about $1,700 to do the audit on the association for not a lot of entries. do you really have to do a full audit on this, or could you indeed just do my company, I don't do an audit, I just have them to do a review of the situation. They submit the tax forms and all that stuff for me. So it's, I guess, I don't, in the old days, I used to always ask, how much is the audit going to cost? Now I ask, you do it well, but I'm, on this one, I'm, in proportion to the risks involved, the audit fees seem high on the foundations.
Yeah, provide some information on that to Angela. I don't know whether she wants to speak to that or whether she wants me to speak to that.
I don't know if Ange is still, there she is.
Sorry. Yeah, so we had received the information from Glenn. It's not required, but to be consistent with the authority and because their arms connected, it is valuable to have Glenn or whoever's auditing the authority to also do the foundation, because there may be, the transactions are in line. So as one is being done, the other is the reciprocal side. So it's nice to have them work together. It is beneficial. We
There's
talked
no
about it at the foundation meeting that there was no concerns, but that's definitely.
There's no question Glenn's the man to do the job. The question is, do we have to, are we paying extra money to get a full audit, or could we just do a review and would that be less expensive? I guess is my comment or my question.
Sorry, I would leave that for Glenn to ask, to answer as to
I
how
haven't
much
asked that
detail.
question for 2 decades, Glenn, but
In terms of the foundation, yes, if the foundation were to not go with an audit, but instead go with a review engagement or even a notice to reader compilation, then there's less cost involved with having that done. So that's entirely at the discretion of the foundation as to what level of review or audit they would want. There was a change in that regulation, trying to remember the notes I sent to Angela, but I think it was probably 2018 maybe, that the requirement for the audit was lessened. So the foundation certainly would have that opportunity to forego the audit if they chose to do that.
well,
Authority does not have that luxury.
Yeah. Well, that I guess we really should leave up to the foundation, but we could make that recommendation that it's not a necessity to have a full audit, and I would trust your note to readers or review would be moderately cautious about what was happening there. And just one other comment, I noticed in the last page of your note, you talk about interest risk, and it seems to refer to the variable rate of interest. I just wonder if that's part of sort of the armor plate that you put on all statements, or is there, I don't believe we've got any risk because we know what we invest at, and maybe it's not the highest rate out there, but can you just say that this is on the final page, 21?
Yeah, the note disclosure is fairly boilerplate, I guess, in terms of the wording. In terms of specifics to authority, yeah, there's not a lot of exposure there. I mean, because they have the fixed rate on their loan, and so it's really just on the renewals of the GICs. And again, you're not getting much interest there anyways, but you know, I guess the risk, which is not very significant at all for the authority, would be if you have a budget amount of revenue associated with your investments, and at the time your GICs come up for renewal, you know, the interest rates are less than what you had planned, and so you don't generate the amount of revenue that you had budgeted. But that's not really a major concern for the authority at this point, given the you know, low interest rates as they are, and there hasn't been much movement in them.
And there's not expected to be much movement for the next year or so. And just what authorities can invest in? Do they have to be GIC guaranteed, or what they call it, Canada Deposit Insurance Corporation or Ontario Deposit insurance coverage, are we restricted to that, or is that in your bailiwick to know about that?
Yeah, I don't know that answer offhand in terms of investment restrictions, whether that's internal organization driven or whether the authority legislation dictates that or not. Maybe Sally or Angela might know, but sorry, I don't know that offhand.
Well, we won't waste your nickel and to inquire on it. There's something we can ask
know.
later on.
I know the authority, since we've been involved, has never invested in anything other than GICs, but I'm not sure if that's an internal decision or not.
Anyway, I just want to say thanks for doing as clear an auditing statement as an auditing statement can be. I always find I have to read them real slowly and so on. So anyway, thanks for your good work this year and in the past.
Oh, welcome. Thank you.
Was there any other questions for Glenn before we move on? Okay, I'm not seeing anything else. So Glenn, thank you very much for taking the time to take us through the financial statements or the draft financial statements and for preparing them and getting them to us in advance of the meeting so we could all take a look as well. I really appreciate that, and I appreciate you spending the time with us this morning as well.
Oh, you're very welcome. My pleasure. I didn't know if you wanted any comments on the audit findings letter or whether you had any questions related to that at all.
If you have comments to provide, I'm sure that the committee would be happy to hear them.
I don't think I really have anything. Can you see it on my screen now, the letter?
Yeah, we can see
I don't
it.
think I really have anything to add to what's written there. I mean, from my perspective, once again, the audit went very well. Angela had everything very well organized. It was, no concerns relative to the internal controls being used. Documentation was excellent. Was able to touch base with Sally and go through some of the litigation. So I had no concerns there. Within the letter, we do talk about the wage subsidy. The fact that we thought we were going to come up with another $76,000 bonus, but now that's subject to review by CRA, so that may or may not pan out. But no, I don't think I have anything really to add to what's written there, other than, again, just to say everything went well. I want to thank Angela and Sally for their cooperation. And, generally just looking at the statements we just went through, I think the authority is in very strong position going forward. Good cash reserves, good investment reserves. So things, and considering the uncertainty of the pandemic, I thought their operating results were very good relative to the budget in the previous year. So I think everything looks to be in good shape.
Well, thank you for those comments, and I appreciate you acknowledging Sally and Angela as well. I know that they work very hard on this as well. So thank you for that.
You're welcome. Have a great rest of the meeting.
Thank you. Thank you again, Glenn.
Okay. Bye-bye.
Bye-bye. And just before we move on, Sally, I'm just going to check with you. Do we need to have a motion that we received this for information or anything like that at this point, or recommend that the financial statements go to the board? No, you're muted, Sally.
Sorry, we didn't last year.
Okay.
And we were referencing what had been done in previous years when Ange and I were bringing this forward last year. So Ange, you're on mute as well, just so you know. So Ange, if you had anything further, because we were just sort of
No, I don't.
practice.
Yeah, exactly. It hadn't had in motion last year, so.
Okay.
I don't
So these
recall
will just
it
go
being
on
on.
to the board's agenda. There's nothing that needs to happen from the committee.
No.
But perhaps recommendation from, or could be included in a minute if you don't want to have a motion, that we did receive this audit with the auditor, this committee. So just so we fulfill our commitment to receive it. I think that's important.
No, I agree.
Good
Let's
idea.
note it. Okay. Well, with that, let's move on to item number 3, which is the 2019 per diem and mileage rates.
Madam Chair, I'm sorry, but I have to leave for 10-15 minutes. I can come back. John, I hope you don't lose quorum. I don't think you lose quorum with my absence, do you?
I think
No,
we're
okay. but I can be back since I don't qualify for pre-diem or any of this. So I'm good. Thank you. But I'll be back if I finish earlier. Thank you.
Perfect. Thanks, Eli.
Can I clarify, are we talking about 2021? Not 2019?
Actually, yes, I think we are talking about 2021, not 2019. I'm reading it right off of the agenda, but
I
you're
should
right.
have said something when the agenda was getting approved because,
Yeah. And the report is for 2021. You're right.
all right, thanks.
Thank you. So Angela, I'll pass it over to you.
There you go. Us copying previous agendas, right? Oops.
Gets us into trouble, eh?
Thank you for- Yes, it does, for sure. Okay, so the per diem, annually, this same report has come forward a few times. And so the cost of living increase is not significant for 2021. We're looking at a 0.1% cost of living increase on the staff salaries to our staff grid, salary grid. The same increase would be extended to the board per diems. So that is what's included here, as well as a recommendation for the mileage. Annually, we survey where CRA is at with their mileage rates, and we check with the National Joint Council and and compare, and we usually follow, as long as they're not too skewed. The history here has been that we would follow the National Joint Council. So the CRA rate has not changed from last year. What they had posted was 59 cents for the first 5,000 kilometers and 53 cents for every additional kilometer. Last year for 2020, we had selected 56.5 per kilometer, and that was in line with the National Joint Council. So they have changed their rate, even though the CRA has not changed theirs. The National Joint Council has reduced theirs down to 55 cents a kilometer. So it's not a huge difference, but to be consistent, we have suggested that we follow the Joint Council like we have in previous years.
Go ahead,
Any
Janet.
questions?
You're muted, Janet.
Again, I'm confused because the motion says that we're asking for an increase in mileage to 55 cents per kilometer. So we should be saying it should be a decrease in mileage to 55 cents per kilometer, right?
Absolutely. My apologies. Absolutely. It's a decrease for sure.
Right. And I mean, I guess it's our decision, but it just seems like 0.1% is kind of pointless. But I mean, it's a lot of administrative effort to go and change a lot of things when honestly we could probably just add it on to 2022. I mean, it's up to you guys, but it just seems ridiculous.
Any other comments, Bill?
Well, I just think, given all the talk I keep hearing about how hard done by we are financially, I don't know why we're increasing it at all. Why don't we just freeze it? We're talking pennies. Show a little leadership.
Yeah, I agree. Like, just leave it the way it is.
Any other comments on that? Phil, you've got your yellow hand up still. I'm not sure if you wanted to comment.
Yeah, I finally figured out how to do that.
Okay.
Yeah, I'm in favor of that. I don't think that 0.1% is going to, diminish our standard of living through the year. But I on behalf of your dedicated employees, I would say let's do the same thing for the mileage rate. Leave it the same. I sent you all a note indicating why I believe that's appropriate. Perhaps I'm not really familiar with how they do that, but I suspect they've looked at last year's cost of things like gasoline, and I sent you a note showing that the cost did go down, especially in March and April, and the costs, that was a big saving for us over the year. They've gradually tried to build up a balance between the supply and the demand. This was, as I indicated in the note to you, a dispute between how much each country should produce between Saudis and the Russians. anyway, we as consumers benefited by that. But my experience in my company is, although my fuel costs have gone down, repair costs have gone up, tire costs have gone up, and insurance costs have gone up. And as you may know, that we ask individuals, we have this system that people can only go one person per vehicle. So we're really to rely on people to use their own cars, and I don't think that should be at a sacrifice to them. And I did send a note and ask Angela somewhat late this morning, say, what would it cost if we did decide to leave it at the same rate? And I don't know if you've had a chance to look at that at all, Angela, but if you could if you give us even an idea, plus or minus $500, it'd let us know whether.
So if I may, Madam Chair, yes, so I took a quick look at 2020 and our mileage costs for the year. Most of our mileage costs that we incur it's almost $95,000 last year. Most of that is an internal transfer from operations, a credit of $87,000. So it's just use of our own vehicles for going out to the different departments for their uses. But we did pay just over $7,400 last year to either staff or to members for mileage costs for use of their own vehicles. So that would equate to $110 difference. If we had saved, if we use the same mileage as 2020 as a benchmark, it would only be $110 difference. So it's not significant to change it down or up. Like, we're not talking large dollars.
I would just like to support the staff on the motion A, but add, if they would look at it as a friendly amendment, that we leave the mileage rate the same.
Do we have comments on those two proposed changes? Go ahead, Bill.
Well, I actually support reducing the mileage rate. So I support that part of the motion.
I'm just gonna go to Sally. Do we still have quorum? Because I think we've lost Paul.
Yes, you do. Including you, we have quorum. Let me just go back to
Or right now, I thought Paul was still on the call, but
yeah, he must have dropped off at a certain point. Let me just make sure. One.
Sorry, you can just hold tight for a second here, everybody.
Yes, we have quorum.
We're good? Okay.
Yeah.
Perfect. So we'll continue on then. So we have a suggestion that we change the wording in B of the recommendation, that it recognizes this as a decrease in the mileage rate to 35 cents a kilometer. And that instead of the 0.1% cost of living increase, that we go with a freeze for our recommendation. Janet, you have some comments?
I think, given the small amount that it would really, leaving it at the same rate, my inclination is that it does send a message to basically leave everything the same. And so, I think we're just saying leave everything the way it is, and we're not increasing anything, we're not decreasing anything. On the other hand, if the majority is that it wants to decrease the mileage rate, I can go along with that. It's such a small difference, okay? So it all depends on the optic that you want to send. So I'll go with whatever the rest of the people want to go with.
Yeah, I'm kind of the same mind as you, Janet, in that optically, perhaps it's best to keep a freeze. But for the little bit of difference, if it makes the difference to put that decrease in for anyone on the B part, the mileage rate, and I'm happy to support that as well. Phil.
I would just comment, if I'd known there was so little involved, I wouldn't have taken the time to have done all this research. But anyway, I'm in agreement with what you've both said. If let's leave everything the same, sounds like a good message to be sending to staff. And if anyone feels hard done by that they're only getting 0.1% for inflation, you say the board took less.
No, I think, but let me just go back here. We're saying we're not going to have any cost of living increase at all.
Yeah.
I think we're
We
saying-
as a board are not, but are we saying that for staff as well?
No, this has nothing to do with.
Yeah,
with-
exactly.
Right, okay. But, going back to who probably feels strongly about this, and I don't wish to put any words in your mouth, Bill, but like, I don't have a problem decreasing the mileage rate. I really don't have a problem with that. If that's what, our standard is to use this Ontario standard, then let's do that. So I don't have a problem with that. And if that's something you feel strongly about, Bill, then I'm happy to go along with that. And again, it sends a different message. It's the optic we want to send. I mean, financially, it makes almost no difference. It's the message.
Yeah, I'm not overly exercised. I voted against the increase last year, so I'm happy to freeze it where it is. I don't understand why it's difficult to decrease it. Everybody just puts in a different number when they file their expenses.
Yeah.
And easy either way, a freeze or decrease.
Yeah, and I should indicate, because you might think I have a conflict of interest, that I don't take the honorarium and I don't take any of the per diem. So I'm not voting with any conflict of interest here. So there you go.
Janet, I think you made a good point of, we typically follow the rate set by the province. So why would we do that differently now, just because it's gone down?
Yeah, what are the
So,
municipalities doing? Are you guys following that as well? Are you decreasing your rates?
I haven't got it from our, I don't know for Bill if he's got something. We haven't gotten anything from our treasurer on it yet, but it typically follows the provincial rate. So I imagine we'll be down as well.
Ours are way less than the Conservation Authority.
Yeah. So it's not a lot of dollars. So maybe in keeping with, what a good message I think might be at this point, given the challenges we have, but also to keep in line with what we've done in previous times, staying in alignment with the provincial number. If for the A portion of our resolution that we freeze board member per diems and honorariums effective the AGM February 17th, and that a decrease in mileage rate to 0.55, 55 cents per kilometer effective January 1st, 2021. Are we comfortable with that?
I can live with that.
We're okay with that, Phil?
Yep.
Okay. So is there a mover and a seconder then for that resolution?
I'll move.
Thanks, Janet. And a seconder, Bill, thank you. So be it resolved that the board approve a freeze to board member per diems and honorariums effective the AGM meeting February 17th, 2021, and a decrease in mileage rate to 55 cents per kilometer effective January 1st, 2021 take effect. Any further discussion? All in favor? All right, thank you. Just gonna go back to the top here. So Angela, an update on grant applications.
So currently, we have applied for Canada Summer Jobs. We've applied for 9 positions, 4 for the monitoring program, 2 water engineering students, and 2 systems programmers. And we've applied for 1 business operation analyst. So these are all positions that are funding dependent. So hopefully last year, our Canada Summer Jobs came in as 100% coverage for 8 weeks per position. So we'll keep you posted. They were all submitted just late last week. And when we know the status of those applications, we'll let yourselves and the board know the outcome of those. Our WECI, we had notice received from the ministry saying that they had some funds for WECI for the 2020/2021 year. Their fiscal year closes at the end of March. So they had funds that they could reassign. We were not successful in 2020 on our regular application, but they have extended $12,500 for us to recoup some of our expenses for the Cache Lake Dam remediation. So we have submitted that transfer payment agreement and included those funds in the 2020 financial statements that you've seen as a receivable, because we'll be luckily receiving something from WECI. So that was a good news story. That's all the updates I have on grants just right yet.
All right, thanks, Ange. Did you say 12,000 from WECI?
Yeah.
Another
12,500.
zero on behind that, but hey, we'll take what we get, eh?
Exactly. So that's at 50% funding, of course. So we had to show and substantiate $25,000 worth of expenditures, which we exceeded that, of course. So.
Sally, did you have a comment?
Yes, I did. I just think that the reason why we were able to get this money is because the province changed its mind on these mid-year reallocations. And I think that the work of all the municipalities in our jurisdiction and in our watershed made a huge impact. And so I would just like to acknowledge and thank all the municipalities and yourselves for the support in passing resolutions and getting that to the province, because I think that was the tipping point for the province to agree to go back to mid-year allocation. So I think the province, all the other CAs that is, has benefited from the work of the CA and yourselves in pushing that issue. So thank you.
Thank you, Sally. Thanks for those comments. Phil, you have a comment?
Yes, was the limit to $25,000 just what they had left in their budget, or did they feel that's all we were entitled to? How did they saw off at that amount of money? We're grateful to get 12,500, of course, but 14,500 would be nicer. So we did, as you indicated, we did spend more than $25,000 is my recollection.
So if I may, so two things. You had to apply the money towards a project that you had already applied for. So you couldn't create a new project. So the projects that we had been approved for were work on the Shabamika Lake Dam and the EA for the Kashwakamak Lake Dam. And we were able to state that the work we did earlier in the year, you'll recall, to do the risk assessment on the Kashwakamak Lake Dam, formed, in fact, a part of the research that one would do in part of the EA. So we're able to justify that piece of work that the board approved last year as being part of the EA that we had submitted WECI funding for. So the actual cost of that project was in around the $25,000 mark, and they paid for half of that.
Yep. You have to be eloquent, eh?
Any other comments on the grant applications update? All right, seeing not, our next item is an in-camera discussion. So I'm looking for a mover and seconder for us to move into closed session for discussion regarding labor relations or employee negotiations. Is there a mover and seconder for this? Phil and Bill, all in favor? Thank you. So we have moved into closed session. Oh, Angela, you're just muted.
Sorry, Sally, am I to leave the meeting?
Sorry, Sally, you're muted.
All right. And you can stay. You're familiar with this, but Chelsea will have to log off. And come back in again. Is that Chelsea at the bottom? Well, bottom of my screen, the MVCA?
Yeah. Yeah, I'll just make sure she's.
No problem, Sally. I've changed the host option over to you now.
Okay, terrific. Thank you, Chelsea. And I'll take care of it, Ange and I, from here on out for closure of the meeting. Okay.
Okay, perfect. Thank you.
Okay, very good. Okay, so I'm going to do a share screen. Okay, I don't know why it's showing up so small. Hold on. I'm going to actually stop the share for a moment. I need to change the view. So if you could bear with me for a moment here. Okay. Now I will share the screen. Okay, thank you. So the purpose of me wanting to talk to you in camera is to address an item that I had hoped to discuss with you at the last finance meeting, but you may recall I lost connection with the Zoom and wasn't able to get back into the meeting. So when you were dealing with the market assessment at the meeting in November, I had wanted to speak to this issue, but didn't get the opportunity to. And then it was to go to the board the very next week or two. So there just wasn't really an opportunity at that time to talk to you about it. So that's why I'm revisiting matters that have already been covered. So what I'm wanting to talk to you about is the methodology employed by Cornerstone and how I think as a board, we need to examine in particular how they treated the positions of the Director of Water Resources Engineering and the Manager of Planning and Regulations positions. I had provided them with a variety of jobs that I felt, based upon my, quite frankly, my experience working at the city and my knowledge of the work that is done, to the consultants to consider. And they didn't. They treated the City of Ottawa jobs and the salaries associated with them as outliers. They said that they skewed the data set. And I did engage with them in discussions with this because the terms of reference for the project was very specific. It had to be a representative of both Lanark and Ottawa, but they were quite firm on that. And I think I'd like you to appreciate that I felt in a difficult position because my position was one of the ones being reviewed. And so I didn't want to push them too much, but I did want to engage with you in this conversation. So as you can see on the slide here, I don't think that a lot of the positions that they ended up comparing those two to reflected the fact that so much of our work and the complexity of our work takes place in the City of Ottawa. Over half our permits, and while it's only 30% of plan reviews, the applications, the planning applications in the City of Ottawa tend to be of a much higher complexity than the ones we're receiving from the townships and the towns, particularly due to the significant stormwater management issues within the Carp watershed. It's just night and day to what we deal with in the other areas of our jurisdiction. It also failed to recognize that we paid the board signed off on and approved me negotiating a wage up to 125, and that's ultimately where I did land with the Director of Engineering. And so the wage bands that Cornerstone identified is actually less than that. And that would mean red circling or freezing the wage of the most senior employee I have, who we depend upon as an organization and who is involved with a tremendous complexity of projects right now. It also didn't consider, and I did raise this with them because I think in our area in particular, it's an issue, is the potential impacts of remote work. And interestingly, we just unfortunately received notice from a GIS, our GIS specialist position. And we went back because that competition only closed last summer and he's a relatively new employee. We went back to the other shortlisted candidates, and one of them was from Collingwood. And he actually said, well, I don't want to live in Ottawa. I want to stay here in Collingwood and work. So the pandemic is changing, I think, the negotiating powers of some, not everybody, for some positions. Now, obviously, the director of engineering, is a position that needs to be here. But what I want to speak to is the flexibility that some of the other positions have that that qualified employee could go to. So I'm just going to go on to the next slide. So this one illustrates for you where our work is across the watershed. This one's unfortunately a bit dated. This was from 2017. That was the most current image I had for you. But you can see that, a huge amount of work does occur in the city of Ottawa or in very close proximity to the city of Ottawa. And which is why I wanted the representative or the other salaries to be compared to the sort of the eastern part of the watershed. That's where our office is located, and that is by far where the majority of our work is located. So here you can see where their analysis came out. And so for the manager of planning, it said basically hold the line where the employee, the wage band. But for the director of water resources, it said, yes, it could go up some. And I mean, the upper band going up 10 is a goodly amount, but it is less than the 125. And it's also less, considerably less than what I think peers are making in this marketplace. So I'm going to show you on this next one for the director of engineering. I'm showing you a range of positions, and this was just off the Sunshine list that's available on the web. And just so you know, I know all these people. I know exactly what they do. I know the span of control they have. I know the scope of the work that they perform. I know the intensity and stress levels associated with all of these positions. So I'll start with the bottom one, actually. The program lead of municipal drainage, it's a very routine job. It basically comprises of 3 tasks: doing the engineer's report on the drainage system, arranging for annual maintenance of drains, and then mitigating problems and complaints. That's really the scope of the responsibilities. And that is, sort of a low-end program manager type of job. Eric Touzeneau, the senior engineer, he does special projects. So he might have a handful of special projects that he's tasked with doing every year. So he is a senior water resource engineer who has maybe a summer student or 2 working for him, but is very special projects oriented. Ryan Polkinghorn oversees the operational side of the stormwater management system in the city of Ottawa. So he's doing the annual work planning around maintenance, and he does comment in his team on planning reviews. But there isn't the same sort of watershed kind of management and modeling. There is absolutely no modeling that's happening. And most of the capital asset management planning occurs elsewhere in the organization. And that brings me to Jen Nielsen. She oversees the asset management and the prioritization of capital works across a cross-section of infrastructure at the city. The span of control that she has within the organization is comparable to our Director of Water Resources Engineering, but it does not compare in terms of the scope of responsibilities or the kind of detailed review that needs to happen of projects coming in where we're actually having to model what impact a new subdivision is going to have on a watershed and drainage in the area. So again, she might have the same span of control in terms of number of employees, and she's dealing with an area that our director deals with, but not the other responsibilities. So Louis Julien, the senior engineer, he is a senior modeler and deals with complex projects at the City of Ottawa, has some staff, but again, tends to be very focused, not on a broad range of things. He's not necessarily dealing with asset management. He's certainly not dealing with design review to the same degree that our group is. I put Scott LaBerge there. This is sort of like the next step up. He's overseeing water services, and at the City of Ottawa, that's all of water, all of wastewater. So I'm not saying that our Director of Engineering position is comparable to the Director of Water Services at the City of Ottawa. But I just wanted you to see sort of the variation and where those wages come out. I can tell you that our current engineer, Director of Engineering, could easily perform any one of those jobs based upon the credentials that he brings to the position, and that the complexity and stress levels and the scope of responsibilities is comparable to Scott LaBerge. And in some respects, it's even more because when the city reorged in 2016, they removed from the operating groups all those sort of asset management responsibilities and put that in the engineering group on the planning and infrastructure side of the organization. So I just feel that these are the kind of positions that I'm competing against when I am looking to recruit to replace people. So now I'm going to move to the Manager of Planning and Regulations position. So at the City of Ottawa, oh, go ahead, Bill.
Yeah.
Well, am I on mute? No. I just thought I'd point out that all of us smaller municipalities that can't afford the wages that the Conservation Authority pays are also competing with those jobs. And I guess I'm not quite sure where we're going with this. This is the consultant that was hired to assess the positions at the Conservation Authority,
Yes,
and you're taking issue with their findings?
with their methodology.
Well, my recollection is I raised concerns about it when you proposed to do this, and I voted against it. I thought it would be a big waste of money. Sounds like that's what, but I do believe that when you hire experts, you listen to their expertise. So I guess I'll listen to this, but I'm just not, if this is just a rebuttal of all the money we just spent on the consultants and we're not going to listen to their expertise, I'm not quite sure where this is going.
Phil? Phil, you're muted.
My apologies. I'd like to hear what Sally has to say, because you're right, we don't want to be, sneaking all the good or buying all the good talent. But the other side of the story is we're now just a short commute away from Ottawa, and I'd hate to lose a good person who's fulfilling any of these positions. So I think we should hear what Sally has to say and then make it, I think it's good to get advice from people, and I agree with your wisdom at maybe we should have just asked Sally to do it. I was a bit afraid the reason I supported the outside organization, I thought if large increases were recommended for Sally's position, you might doubt whether that was right or not. And so I think it's appropriate that let's hear what Sally has to say, and then we can maybe have a little discussion and see what's appropriate. Thank you.
Want to carry on, Sally?
Okay. I don't see on my screen, but is Janet still on?
Yes, we still have Janet.
Yeah, I'm still here.
Okay, I just don't see you on my screen, Janet, that's why. Okay, so with respect to the manager of planning and regulations, these are the positions, the planner 3 that I think is probably most comparable to the scope, complexity, and the nature of the work that our manager does as a planner 3 at the City of Ottawa. So as you can see, they're all in the 110, 112 range. This next one I'm just showing you because the next one down, some of these people have, as little as 5 years of experience. They're sort of mid-range kind of planners. They're not totally entry level, but they're certainly not this kind of senior planner that we require to deal with the complexity of issues in the watershed, and in particular in the Eastern watershed. One of the key themes that we keep on discussing is the fact that all the good land has been developed. Any application that comes in now, more often than not, has some sort of encumbrance associated with it that impacts the drainage and the whole ability of the developer to optimize to their satisfaction the number of units they're going to get on that land. And so it needs to be tremendous rigor and I'll say negotiating prowess to be able to work effectively to manage these various applications. And all of these positions come in higher than what had been identified. So at this point, maybe I shouldn't have, should I stop share or will people want to go back? Because I'm just going to speak a bit more to this. So where I'm going with this basically is I'm actually seeking your direction. I don't have a motion to put forward to you right now. I'm sharing this with you because I'm concerned. I'm concerned because I know based upon other jobs that have been posted within the towns and municipalities in the balance of the watershed. So I just presented on the City of Ottawa, but in the balance of the watershed. And there is huge competition in the marketplace for managers of planning and I think about DNE, who their head of planning or their planner was a summer student to us. And so Bill, I fully understand what you're talking about. There's tremendous competition for people. And the problem is, unless you're willing to pay, you're not going to get really
But the point is we're competing with you and we cannot afford what you can afford to pay your employees. You're $20,000 above us in every single job. So that's my frustration.
Mhm.
We just hired a director of not planning, of works. We can't come close to your salaries, let alone Ottawa's.
Mhm. So, may I, Madam Chair? And I understand that. It doesn't negate the challenge we have in that further to that map I showed you at the beginning of the presentation is what a huge amount of work is occurring in areas with far more complex planning applications than you're seeing in Lanark Highlands. And we have to do detailed modeling to evaluate those.
Go ahead, Janet.
I think the thing that would worry me about losing a qualified director of engineering is the fact that we're going into these major dam replacement projects. We're going into millions of dollars of capital, renewal over the next 10 years with our plan. And so we need to have a very competent director of water resource engineering to do all those dam replacements. And I recall when we hired him and when the board approved, paying $125K as the maximum, that was one of the reasons that we agreed to that, is because we desperately needed to have a highly qualified individual. And so I think I certainly am sympathetic to the, the more rural municipalities, but the problem is that MBCA straddles two worlds. It straddles a very urban center, which pays 90% of the levy, and 10 other municipalities, which don't have the same complexity. And so I think this is this dichotomy that we're seeing, that you're dealing with, consultants aside. So if we were to lose our qualified director of water resource engineering in the middle of doing these dam replacements, we would be screwed. And it would take a lot of time. Like, we'd end up, possibly, if we had received the WECI funding and this person decided to leave in the middle of the project, it would take us quite a few months to try to find somebody to come in, get them up to speed, even more months. And it may very well be that we would end up losing that money that we had received because we couldn't execute the project within the scope, the time that was allowed. So I think that, paying if we are looking at having to pay more to keep this person, that's a risk management issue. That what we are doing is we are reducing the risk to the Conservation Authority of losing an individual who is critical to the operation, particularly of these capital projects. So that's how I would view it, as a risk management, what's the word, activity, risk management activity.
Bill?
But then I guess my response to that is, we went out and hired professionals, experts in this area, to come back and tell us how to mitigate that risk, how to keep our best people, how to properly compensate them. And now we don't like the methodology or the results. So I don't have the expertise. And I was told we didn't have the internal expertise. So I'm not quite sure how the five of us know more than the experts.
Bill?
It's important enough to hire them and pay them.
I'm inclined to agree with what Janet has suggested, that we're at a critical time and we really want the best person available. In my own company, a couple of times I've hired the cheap engineer, and it was a nightmare when they didn't do it well. And I wind up paying more in consulting fees to supplement what the less qualified engineer was doing. So that would be my fear if we lose Earl. I've talked to him on a number of occasions. We don't always agree on stuff, but I can see behind him a good methodical way of doing stuff. He's well informed. He understands the difference between whether promoting the dam as a water retention area as opposed to as what do they call it, where you supplement the summer flows, that kind of thing. I think Janet is right. To go out and find the guy who's available and can do that is really not. It's a poor time to be even taking that chance. So I think I'd listen to what Sally has to say, and perhaps as the smaller municipalities, what I do with my auditing firm, I don't have a very expensive audit. It isn't one of the ones that have, lots of named people there. But I say to them, if we've got an issue that looks like it's really complicated, then let's, for that particular thing, hire a person with real expertise in it. And I've done that with taxes and other things, and it's always turned out well. So that'd be my thought for smaller municipalities who don't have quite as complex problems. But when you get to a tough problem, don't be afraid to go out and spend a bit on consultants to up your whatever your finance budget or your engineering budget or whatever you need to where you need particular expertise. Thank you.
Sally?
Yeah, Bill, I want to pick up on one of your comments back to when we first brought forward the concept of hiring Cornerstone. And I'll agree with you. And in theory, we absolutely could have done our own market assessment and comparison. the bulk of their fees actually were to help us with the job evaluation, which none of us had ever done before. And that was by far where most of the money went, was for them to guide us through evaluating and rating the positions, and figuring out which pay band they should be in. I definitely felt that because my position was one of the ones to be evaluated, that I didn't want to do that in-house in terms of the market assessment, but that was the primary reason, and that was added onto their contract as part of their work. So I understand where you're coming from, but I just want you to know, though, the work they did helping us with the job evaluation was terrific. And by and large, I was very comfortable with the rest of it, of the market assessment work they did. It's just with these two positions, I just felt that because they didn't include City of Ottawa positions, that we really kind of missed the mark on those two.
Any other comments on this one? So we don't have, did you want to go ahead, Sally? Did you have-
Well, my main goal in having this, engaging with you in this conversation is I'm bringing it forward to you because, for starters, I need to know whether or not there's any interest, whether I should be bringing anything forward to the board at the AGM to address this. And if you felt that there might be support for me to bring forward some recommendations in terms of how we might address compensation issues for these two, I'll bring something forward. But I don't want to bring something forward to the AGM meeting if you don't see that it could have some success.
Sorry, Janet?
Does it have to be at this board meeting?
No, actually, you're right. It doesn't have to.
Yeah, because I think we have enough to deal with, that we are going to have enough to deal with at this board meeting,
Yeah.
right? And I think since salary increases are not considered until later in the year with the performance appraisals, I would suggest that we hold off. I mean, here we are approving, the AGM, we'll be approving the budget,
Yeah.
right, which took into account not anything significant in terms of, the salaries that we're going to be discussing. So we would have to be, having to approve a budget, then realize we want to increase something potentially or not. So I really think this is not the right meeting to have it. I also think that it would be better to have this discussion with, I don't know if we're having another finance committee meeting in the next few months, but I think we need more of our finance committee members. That would be what I would recommend, Madam Chair, so that we can get a more fulsome discussion of the topic and actually have a recommendation, Sally, that you would be bringing forward. I think that's what we would need, is that we need another discussion and understand the impact, because we're talking potentially a municipal levy impact, or are we talking operating reserve impact, or what are, in the near term, and then the 2022 budget, what does this all mean? Okay, so but in conclusion, my biggest concern would be losing a very capable individual and the risks that this would cause to the organization. That's how I see it, is a risk issue. And of losing an individual. And I've been through this in my corporate life. And I realize that we don't have the same latitudes as a corporation, but man, if you lose some of these guys, it can kill you. And I, in the past, have had to pay risk reduction money, salary increases or bonuses to keep people during critical periods. Another option, although it's difficult because we are so lean, is that you always try to have somebody in waiting, like somebody being trained up. Now, again, that's possible in the corporate world. It's hard with a very lean organization to do that. So when somebody leaves, you may have somebody more junior, but they're simply not ready to step up into the position. And so that route is something to be looked at, but I'm sure it's going to take longer than, a year to get somebody up to speed to the level that these people are at. So anyway, that would be my recommendation, is we need a larger finance committee discussion with something that that you're actually going to be proposing for how we would potentially deal with it before it comes to the board. And I don't think any of us here are ready to say, yes, do it. I think we need to understand it better. Anyway, thank you.
Did you want to go ahead, Sally?
I just wanted to say that we are going to have another meeting in March, because our bylaws require that if we want to borrow this year, that we have to have approval from the board by March 31st. So we probably want that to come forward to the finance committee meeting before going to the March board meeting.
Okay. To tag on to what you were saying, oh, I am unmuted. To tag on to what you were saying, Janet, I don't think this is something we can make a decision about right now. There's not enough of us, I think, either, to represent the views of the board, or even just the committee well. A few notes I made just as you were making your presentation, but just as I was hearing the comments as well. I think it would be helpful to the discussion to follow that line of thinking as to what risk does it bring the organization, and what are the other potential solutions if we were to lose the individuals in these positions, if we weren't able to attract the level of experience that we're looking for. I mean, just speaking from my own experience here in Mississippi Mills at the moment, we've got a bit of a shuffle going on with a lot of our senior staff, and we're leaning on consultants for a lot of the more challenging work. What would that look like for the MVCA? Is that a solution or is it not? And if we can have a discussion about what those other options might look like, I think that would help for a fulsome discussion. But the intention as well, if we were to go forward with a change, how do we do that? What does it look like? What's that impact going to be? The slide where you had the work, I think it was from 2017 in your slide deck. If it's possible to see something more up to date, I think that would be helpful. But it's also if we had a sense of what is the challenging files. I mean, I think we have a sense of some of them, but if we have a more fulsome idea about what the work is, I think that might paint a picture, or it might help discussion in any case. And then the last thing I wrote down here is just an understanding of the scope of work that Cornerstone had provided, what it enables us to do next time around that we weren't able to do now. Because I mean, I appreciate Bill's comment in that we hired experts to do something and now we're moving beyond what, or it's being suggested to be moved beyond what they had recommended. I think it would be helpful for me to understand fully, like, what was the value that Cornerstone brought? And I'd like to understand the gap a little bit more. If there's anything more to it other than they didn't include City of Ottawa in their calculations. And I don't know, does anyone else have items that would help the discussion when we meet to do this again? Are there other items you'd like to have included for that discussion?
I think your list was very, very good, Krista. And I like your approach of, if you treat it as like a true risk assessment, where you look at the options for how you would mitigate that risk. And I think that's really quite valid, because there might be, maybe there are others to raising the salary.
There could be, and I don't think we have enough information to be able to even discuss that fully right now. And as I say, I mean, just because it's working for us to be leaning on a consultant to get through some difficult times right now, that might be a solution or it might not be. I think that's something for us to chew on and to understand a little bit more fully. Is there anything else we want to touch on with this before we leave the closed session? No. Okay, so our next steps will be a further discussion with the rest of the Finance and Admin Committee in March. And we'll just provide that direction then to you to bring back a little bit more information so we can have that fulsome discussion.
Okay.
So am I on the right track there? I don't think we need any kind of a motion because that's just direction to have another conversation.
That's
Okay, perfect. And just going back to my resolutions here. So we don't have a resolution in closed session, but we would need a resolution to go back into, to move out of in-camera discussion. Is there a mover and seconder to move out of in closed session? So Phil and Bill, thank you. So be it resolved that the Board of Directors move out of in-camera discussion. All in favor? Thank you very much. And I have something here I will read as rise and report so that a closed meeting was held. The item considered concerned discussion relating to labor relations, and there is nothing further to report at this time. And I think that's the end of our meeting. If there's anything else, Sally,
Nothing from me.
we're good. All right, in that case, I thank you all very much and thank you for holding on. So we had quorum. Did you have something? Janet, are you moving adjournment? You're muted, so I'm reading your lips.
I move to adjourn.
Thank you. Is there a seconder
Get out of
to
here.
seconder for adjournment? Thanks, Bill. So be it resolved that the Finance and Administration Advisory Committee meeting is to be adjourned. Is all in favor of that motion? Thank you very much, folks. So
Thank
we
you,
are
Krista.
adjourned. Thanks,
Thank you.
everybody.
Thank
Thank
you,
you.
Sally. Krista. Bye-bye.
Goodbye, everyone.